Hello, this is Jeremy North with your educational economic update for May of 2022. Well, in this month's video, I'll discuss major headlines that influence markets in April and economic and market events that we are looking at to influence May and returns going forward. Please stay tuned at the end of the video for the always exciting required disclosure statement. Well, markets continued their challenging ways in April with the continuation of higher inflation and the Fed calling for more restrictive monetary policy through raising interest rates. Markets fell hard in April. For the NASDAQ, its monthly decline of 13.3% was its worst April performance since 2008. For the S&P 500, down 8.8, and the Dow Jones down 4.9, it was their worst April performance since 1970. The bond market, represented by the aggregate bond index, was also down 3.97% and is down 8.95% for the year. A good comparison for the bond index is the Vanguard Total Bond Index Fund, and it was down 3.85% for April and down 9.63% for the year. To put the bonds market decline in perspective, the worst year in Vanguard's total bond index was in 1994 when it lost 2.66%. This year-to-date number is negative 9.63%, and the trailing one-year return of negative 9.65% is its worst drawdown in history. Most bond indexes have seen their worst performances ever. The long-term Treasury bond ETF, which is TLT, its symbol, which traditionally has been a safe haven investment when equity markets are volatile or down, it has lost over 20% of its value during 2022. As I mentioned, the main culprit in April was the Federal Reserve's continued plan for interest rate hikes in their fight to reduce or slow down inflation, along with the recent 0.5% increase in rates. This aggressive stance, along with continued Russian aggression in Ukraine and a resurgence of global COVID lockdowns, particularly in Shanghai, which is causing some renewed supply chain delays and inflation, these are the main reasons for the extreme volatility we saw in April. In addition, the initial GDP estimate for the first quarter came in much lower than expected at a negative 1.4% rate. If the second quarter contracts as well, we may have a recession we're looking at to deal with. With these big up days followed by big down days, including the first week of May, there have been 10 days where gains were greater than 3%, followed by days of losses greater than 4%. We feel there is nothing to panic about, as we have seen this kind of volatility before. If we're looking at a long-term perspective, the S&P 500 has had an average intra-year drawdown going back all the way to 1950 of about 13.6%. This is approximately where we are right now. While this doesn't feel good emotionally, we have seen this volatility and these volatility swings before. With all this bad news, it's good to learn that there is some good news out there as well. While the economy did shrink in the first quarter, corporate earnings have come in better than expected. According to the data from FactSet, as of April 29th, 55% of the S&P 500 companies have reported their results. Of those companies, 80% have shown better than expected earnings per share, and 72% have seen an increase in revenue. We are hopeful that the Fed can contain inflation and help the economy resume its growth track while avoiding a recession. The bottom line is that we all have our eyes on these factors. We have seen this kind of volatility in the market before, and our asset strategies are positioned for these markets, including others. We're diligently assessing the economic and political implications for the strategies and portfolios. Should you have any concerns or questions, or would you like to discuss your personal situation, please make sure to give us a call or send me an email, and we can definitely set up time to talk. With all that being said, here's the disclosure that I'm required to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again, Jeremy North, signing out for the month of May. I hope you have a great start to your summer, and I look forward to seeing you all very soon and talk to you again in June. Take care.